Welcome to the Mercia Brief. PI World are delighted to be bringing you this comprehensive overview of Mercia Asset Management. We open with the normal disclaimer. I now hand over to Dr. Mark Payton, CEO.
Thank you and welcome everybody. Mercia is very much a domestic asset manager focused on sourcing and supporting what we call thriving regional SMEs, small to medium sized enterprises, predominantly sourced from the regions. And we've got 400 of these businesses now across our portfolio. And what you'll hear over this session are the many sort of synergistic elements that operate across Mercia's investment model, making Mercia very much greater than the sum of its parts. And of course, most of this implemented through what is I think, an exceptional team here at Mercia. We are a people business, and I'm very, very proud actually of what the team has achieved over the last 12 months. And we'll hear a little bit more about that in a moment. But they, I think, have really shone a light on what it means to be a proactive, supportive, and frankly, responsible investor over an unprecedented period. We've got over 100 employees in Mercia who are located, physically located as we start to return back to offices across the regions and across the UK. And within what I call the capital deployment team, they're delivering private equity, debt, and venture capital. And we refer to this as the complete connected capital. And what that means is you've got these discrete pools of capital that can work independently, or they can work connected together or follow on from each other. And that's really valuable, and you'll hear from portfolio companies later on, but it's really valuable as business owners, founders, management teams seek the right capital at the right time. In addition to this, Mercia is in the enviable position actually of having something like 250 million free unrestricted cash across the group. And importantly, approximately 50 million of that is what we call proprietary capital, money held on our balance sheet. And that's fundamental to our investment model. And our investment model is one of funds first. So a majority of our assets under management, so within our funds under management, over 700 million is in third-party capital. And of those 400 companies, the majority of those are found within those third-party funds under management. But what our balance sheet does, our proprietary capital does, is over time selectively co-invest with businesses coming out of those funds and growing and accelerating their growth. And in addition, that direct investment can be an LP, a limited partner, in funds where things are working well, or indeed into areas, new areas that we're looking to raise and accelerate funds. So very much a catalyst for future funds under management. And if you bring that hybrid model, the free capital and that great team I've just referred to at Mercia together, and then you look at the networks that we benefit from. If you've got 400 companies and the suites of management teams and NEDs and advisors around that, that's an enviable and remarkable network for us to be benefiting from. And what we bring there is an opportunity to connect that capital up and support those businesses with internal capabilities as well. And so one of those is something we refer to as portfolio resourcing. And here we're able to work with founders, with management teams to add members to the boards, to the executive teams, to the senior management teams, to the benefit of the investee, but not the cost of the investee. That is a cost that's borne by us to support the investee going forwards as we look to be that first choice investor for the investees. We have a suite of funds that we manage, and which means that investors have a choice as well in terms of joining us. These could be institutional investors in our venture capital, private equity or debt funds, or indeed private investors in more tax efficient funds such as our venture capital trust funds, the Northern VCTs, or our CDIS or EIS, Enterprise Investment Scheme funds. And then you bring that all together with something that is an absolute central thesis and plank really to our operation, which is something that's being talked about a lot at the moment in the media, which is ESG, environmental, social, and corporate governance. This is, as a regional investor embedded in the community, this is absolutely central to us and really, really important. And you'll hear more from Jill later on about what we're doing in terms of ESG. I think it's worth also just reflecting on what has been a remarkably challenging for many period the last 12 months. And it is remarkable to think that it has been more than 12 months now since that global pandemic hit us. And I think, at that point, the world was facing a very uncertain period. And actually how we treated this and how we developed here is we treated it just like any rapid economic crisis, frankly, a 2008, a 2000. And Julian and his team took a very pragmatic approach to this and almost divided it up, if you like, into 3 areas of focus. The first one was looking at the fact that there's a philosophy always with these corrections that you've got winners and losers. So which are the sectors here that frankly are the losers that are going to be here? These are hospitality, entertainment, and automotive. And we took some very hard and tough decisions within those sectors. And then, of course, they're into areas of businesses where you can see that there's a pause or a pivot or a continued growth required, where we put resource, we put support into those businesses, and of course, finance those businesses ready to emerge during this period. And then the final bit, which I think our industry sort of just forgot about, was doing new deals. If you're building a sustainable investment business, it's not just about supporting portfolio, it's about doing new deals. And actually, we've been digitalizing our entire operational process across Mercia ahead of the pandemic, thank goodness. So during the remote working, etc., we were able to switch to that very efficiently. But digital deal origination was something that we've really driven through as well. And that has been really important to us. And that has brought through a strong quality and quantity of investment prospects, which is important to a sustainable business. And actually, looking back on the last 12 months, what we have now, as we've backed more businesses and deployed more capital in the last 12 months than we have as a group ever before. So this has been a remarkable period, and it's back to the sort of exemplary behavior and operation of our team. But of course, it's not just about picking businesses and supporting businesses, it's about investment returns. And again, this last 12 months has seen the best period for us in terms of exits. We've had 7 exits across the group in the last 12 months. Abingdon Health, IPO on AIM, that was supported initially through a regional fund, the Northern Powerhouse Investment Fund. We've seen 2 VCT exits, it's all good, and Agilitas, an excellent exit with Agilitas, and 4 EIS exits, Refract, Native Ancient Company, Clear Review, and Oxgene, 3 of which were shared with the balance sheet. And I think just bringing this all together in terms of our investment model and progress, Oxgene's worth just spending a few seconds on. So those networks I talked about, how we're leveraging those through, this was a deal that came through our networks from a serial entrepreneur. We supported it first with CDIS, then with EIS, and that gave a blended return. This was a full cash exit, and save for the IPO at Abingdon Health, all the others were full cash exits as well. And that gave a blended return of 14 times money multiple back to our EIS and CDIS investors. Then the balance sheet came in and accelerated the growth of the business, and that got a blended return of 5 times money multiple. But also using our internal resources, we added to the management team, to the board, and to the executive team there, again at our cost and the investees' benefit. When the balance sheet came in, we grew the syndication. The capital that came into that money was through our own introduction, and we moved that forwards. And then at exit, we drove that process towards exit. So it really does exemplify what we're trying to do here at Mercia in every investment that we make. And I think just closing out on this introduction is all about looking forward. So that's the last 12 months. But what's it like going forwards in the next 6 months, 12 months in the coming period? Well, I think it's been really interesting observation in terms of software. And software has been an area that investors have been investing in for some time. And during this period, there's been an absolute acceleration in that value delivery from software businesses. But I think what's also been interesting during this period is how life sciences have really come to the fore. So diagnostics, you've heard vaccines, but now it's all about biomanufacturing and new technologies coming through on a preventive medicine basis, I think is going to really shine a light in that regard. But also now what we're seeing is we start to see software, I think, peak, and we've got life sciences coming through, is we've got new sectors that are being driven by government pressures, regulatory change, and consumer pull, such as deep tech, clean tech, and purpose-led businesses. And you'll hear more about those later on too. And if you look to our funds, and back to the point about making new investments, you can see those things going on within our funds. And of course, over time, they'll come across to the balance sheet. I mean, Faradion, a fabulous business, sodium ion technology business, was in our funds and came onto the balance sheet. You'll hear more about that in a moment. So I think as a business, we're extremely well placed to take advantage of these opportunities. With the cash that we have, we're extremely well placed to support existing portfolio as well as new businesses. So in a moment, you'll hear from Martin Glanfield, Mercia's CFO, Julian Viggars, Mercia's CIO, and Jill Williams, who's within our private equity investment team, she's an investment director there, but importantly heads up the charge in terms of ESG, our ESG team, and the initiatives there. And they'll give you an overview and flavour of the last 6 to 12 months, as well as what we like to see as themes going forwards. After this, we'll be available for questions. We look forward to taking those questions from you. That's the whole purpose here, is to engage with our broader community. But before then, I'll just pass you on to Martin Glanfield, and thank you for your attention.
Thank you, Mark, and good afternoon, everyone. The year to 31st of March 2021 has certainly been a period of many twists and turns, and I'm pleased to confirm that the group has not had to rely on any state support during the pandemic, nor delay any payments to suppliers. In our interim results to the 30th September 2020, we reported good overall progress, despite much of that 6-month period being in lockdown and all of it including remote staff working. Revenue increased 51% to 0.4 million. Adjusted operating profit increased to 1.1 million. We recorded an initial realised gain on the sale of the native antigen company of 1.7 million. And first half fair value movements in the direct investment portfolio totaled 6.7 million. Taken together, first half profit after tax was 8.3 million. These encouraging results and near-term future prospects enabled Mercia's board to declare a maiden interim dividend of 0.1 pence per share, which was paid in late December 2020. Market analysts responded to our positive interim results by increasing their full-year adjusted operating profit forecast from 1.6 million to 2.2 million. Whilst the focus during the first quarter of the financial year had been on portfolio stability and assessing investee company funding requirements, the second quarter saw the emergence of several sectors whose growth was accelerating. These included sectors of particular focus for Mercia, such as life sciences. The successful sale of the native antigen company in the first half year was an early sign of accelerating M&A activity in those faster growing sectors, of which more was to come in our second half. On the 1st of March 2021, we made 2 stock exchange announcements. The first one reported our successful exit from our second largest direct investment, Oxgene. And as Mark's mentioned, the 5x exit multiple has validated our regional funds first business model, and it's evergreened our balance sheet. The excellent investment return and significant cash proceeds received prompted the second announcement, which was a trading update. In that announcement, we indicated that full year profit after tax was now likely to exceed 23 million, due both to a higher second half adjusted operating profit performance and the value creation progress being made by our direct investment portfolio. We also indicated that year-end unrestricted cash would be approximately £49 million. Once again, analysts raised their full year adjusted operating profit forecast from 2.2 million to 3.2 million, which now includes the £284,000 performance fee, which we received in December 2020 under one of our 3 VCT fund management contracts. Finally, we have recently announced that our preliminary results will be released on the 6th of July 2021, and we are looking forward to presenting what will be record results for Mercia to the market. Our group is in very good financial health, and we are optimistic about the current financial year, where we are already seeing some encouraging indicators. I'd now like to pass over to our Chief Investment Officer, Julian Viggars.
Thanks, Martin, and good afternoon, everyone. Now, I'm not going to repeat what's already been said, but I will use some of the companies on the slide to give a flavour of what we've been seeing across our portfolios over the course of the past year. So firstly, the numbers against some of the assets, for example, Oxgene, are the multiples of cost that we achieved on the exits for our funds and our balance sheet. So the native antigen company and Oxgene were from within our life sciences portfolio. And it's fairly amazing, really, to think that both of these companies, the actual exit transactions, were done almost entirely online without meeting any of the buyers face to face. We continue to see some really interesting opportunities in the life sciences sector. Moving to our software and digital assets, these have also done well. You'll hear from Dave from Voxpopme in a short while. Alongside that, in Technica, which is a regional fund asset and also a balance sheet asset, has also performed very well with its products and services aimed at e-commerce efficiency and security. And indeed, our own e-commerce businesses themselves have prospered over the last year. VCT assets, Entertainment Magpie and Oddbox, have shown pretty explosive growth, actually. And you'll see an interview with Emilie from Oddbox later in this session. On to our deep tech and manufacturing assets. Now, we've all known about the electric revolution that's upon us. We've known about that for a while. And Mercia has really been investing in this whole area for the last 10 years or so. And that's really because we know it takes a long time to build fundamental tech and disrupt markets. And we also know that not everything goes completely according to plan. At the start of the pandemic, again, as Mark has already said, last year we were particularly worried about the auto sector, where we have a number of assets. And this was really because all OEM engagement really stopped for a number of months in that sector. But later in the year, we learned of the 2030 ban on new petrol and diesel cars in favour of electric vehicles. And this has really brought parts of the sector to the forefront of the car makers' minds. So Warwick Acoustics, for example, develops very high quality, flexible, lower cost audio solutions for the quieter car cabins of the future. And Impression Tech develops and licenses its lightweight aluminium platform and components, which do include battery boxes for electric vehicles. And both these businesses now are seeing significant new interactions with the OEMs. Elmtronics from our Northeast Fund is an installer of electric charge points, and also doing very well, as is Midlands-based Acceleron, which enables individual battery cells to be replaced as charge efficiency drops, as opposed to replacing a whole battery unit. Now, part of Mercia's model involves us investing very early and even creating businesses in our third-party funds. One of those is a business called Asset Cool, which is really looking to some of the significant issues of energy loss in electricity transmission cables. Another one of those companies is indeed Faradion. So both examples of us going right back to square one and creating businesses. So 10 years ago, we sought out and backed the founders of Faradion to research and create fundamental new IP in sodium-ion electrochemistry for batteries. And as Mark said later, we provided further scale-up capital, as is our model, from our balance sheet. So like Mark and Martin, I'm very optimistic for our portfolio companies for the future. We do have over 400 assets and with significant liquidity to make new fund investments and indeed direct investments from Mercia's balance sheet. So now I'm delighted that we have the CEOs of both Faradion, James Quinn, and Dave Carruthers from Voxpopme here with us, and I'm going to ask them a few questions. So maybe firstly, can I ask both of you to introduce yourselves and your businesses? So James, why don't you go first?
Yeah, hi, thank you, Julian. So James Quinn, Faradion Technology, it's a pleasure to be here. I think as Julian pointed out, like all overnight successes, we've been working very hard at this over the last 10 years. Faradion has developed a battery technology that's an alternative to lead acid and lithium ion technology. Sodium ion is a safer technology. It's certainly a much more sustainable technology, which has become massive interest today with all this climate awareness that we have going on. And it's a lower cost technology as well. And Faradion sodium ion technology is the first new battery chemistry to come on the market in essentially the last couple of decades. So very excited to be here. Thank you.
Thanks, James. And Dave, over to you.
Yeah, thanks, Julian. Pleasure to be here as well. My name is Dave Carruthers. I'm the founder and CEO of Voxpopme, the leading video survey platform, really helping the world's biggest brands like Mondelez, Microsoft, eBay, and Diageo be much more customer-centric in their decision-making process.
Thanks, Dave. Okay, so first question. and I'll go to James first. So James, what was the biggest challenge you faced in 2020? And I guess what have you learned from it?
I hope I don't have to just pick one. We've had a number of challenges in 2020. As they say, these were the best of times and the worst of times. I think on the positive side, as I said, we've had massive interest from the technology. We've been working on it for 10 years and bringing it into the market. So I think the market's reacted globally very positively from a number of quite large blue chip companies as well. I think on the challenge side, it's initially was really balancing the health and safety of our team. We don't have a deep bench, and so everybody's critical to our success, but also at the same time balancing the health of the company. And so initially we sent people to work from home. We put people on a 20% salary deferral to, kind of manage through this crisis. And people rose to the occasion. I mean, our employees, some of them offered to forego their vacation pay, and everybody really became a real solidarity effort to ensure the success of Faradion. We couldn't travel to our partners and our suppliers. I think that was quite difficult. So things took longer than we would have liked. And I think probably the most unusual thing was, for the first time in my career, I hired a C-level executive to my team, a CFO, whom I never met face to face, only through Zoom calls, and brought him on board, and it turned out to be really a great hire. So these are, there's challenges, but they create opportunities as well.
Great stuff. And Dave, same question to you. So biggest challenges for 2020 and what you've learned.
Yeah, I mean, the opportunity to talk about 2020 feels like a therapy session, so I'm going to take it now. I guess Q2, everything kind of stopped. Nobody really knew what to do. It was kind of an unprecedented occurrence. There was really a paralysis in the market. We had some clients that the businesses were really badly affected, clients like Airbnb, Expedia, Alaska Air in the travel industry. But then we had some CPG clients like Clorox that absolutely exploded with everything that was kind of going on in the world. As a business, we reacted really quickly to the changing landscape, supported by Mercia. We were able to adjust our cost base quickly and implemented some cuts in headcount. But the team, much like James, rallied round, and we took kind of short-term cuts. And it was incredible to see how a crisis like this can really bring people together. I would say in Q3 we started to see those signs of recovery. People realized they needed to react. Challenges was probably lead generation, kind of top of funnel stuff. We'd relied so heavily on in-person networking, building relationships, and we needed to switch to more of a focus on the digital demand generation. So the lesson really from that was to not become over-reliant on any one channel for marketing, and then also focus on building and maintaining that culture. That was a real key part of Voxpopme and always has been, and how you build and maintain that in a remote world was difficult. And then finally, to make up for the difficulty in bringing new logos in, we really had to double down on our existing install base. How could we drive expansion opportunities with install?
So next question, again, we'll go to James first. How has the need for your products evolved during 2020 or indeed the pandemic?
I think one of the things that became very clear was the vulnerability of the supply chains. That was really pushed to the forefront. I think it's unbelievable how many supply chains are dependent on China. And this is true from antibiotics to air conditionings, wedding dresses, and batteries as well. And, as a result, lithium ion is really controlled by China. 80% of the cost of the cell is the materials. And so I think a lot of people woke up to the supply chain security issues related to lithium ion technology. And sodium ion does not depend on those materials. We don't use conflict materials such as cobalt. We don't use any lithium or copper in our materials. And as a result, we have a much more flexible supply chain. And I think that's become very important. And if you look at countries like India, for example, they're the largest importer of oil worldwide. And they're, of the 30 most polluted cities in the world, 22 are in India. And if they want to clean up their environment, they have to go towards renewable energy, become dependent on China. And sodium ion is presenting an opportunity to get energy security. which means national security, economic security, and environmental security. And I think as a result, this has really created a significant awareness towards Faradion and sodium-ion technology and the role it can play for not just energy, but energy security as well.
Yeah, great, thanks, James. And same question to you, Dave. And how do you see the need for your product? How did that evolve during 2020?
Yeah, I would say that whilst COVID at first was a real headwind and difficulty achieving new logos, it's become a real accelerant and a tailwind for our business. If you think about the amount of change and digital transformation that's happened in the world over the last 12 months and how that's accelerated, there's a huge focus now and investment being made by companies across all sectors in understanding this new normal, in understanding how consumer behaviors and habits are changing. What opportunities are there to launch new products, new services, new experiences? And people are realizing that simple surveys are not providing enough insight. The traditional ways of getting to the why, getting closer to that customer, was through traditional qualitative focus group, in-person interviews. Those things all went away overnight. So many clients and companies across many sectors are transitioning how they understand clients and looking at, what is the new way to connect with consumers, and video and Voxpopme is now becoming their go-to choice.
So it's been good for you in net terms, Dave. Would you say?
Yeah, I would say in net terms it has been an excellent to the business. Obviously, the impact initially was felt, but it's been an opportunity for us to reposition the importance of customer centricity, getting closer to customers, and really kind of the agility that the tool offers.
Okay, so another question, perhaps the final question, I guess again to James. So what can we expect or hope to see from Faradion in 21 and further out?
Well, I think you certainly start hearing a lot more about Faradion as we're bringing the technology into the market. In March last month, we just launched a joint venture in Australia. We've already received the first orders for approximately 40 packs for energy storage applications. I think in the UK and Europe in particular are kind of well known for developing technology, but having it manufactured and commercialized elsewhere. I grew up in the 60s in the US, and it was all about putting a man on the moon and, getting the whole nation behind that kind of an approach. And I think the US was very successful. We did that, beat Russia. And then we kind of stopped, and then the U.S. had to pay Russia to put an astronaut on the International Space Station. And you cannot outsource space exploration or your intelligence with satellites, and you cannot outsource your energy security. And this is something that the UK is seeing, that there's certain technologies that are still too early. And lithium ion, the train has sort of left the station for the UK, and sodium ion is in its own backyard. Faradion's been working on this for 10 years, deploying this technology, and I think we're seeing significant interest from tier one telco players in the UK, from national grid type players in the UK, and we're looking to put in a manufacturing line in Sheffield to be able to really take a large position here in the UK for sodium ion technology. I think it's a unique opportunity in the future, and we're excited to keep sharing these kinds of updates with you.
Exciting times. Thanks. And Dave, same question to you. What does 2021 and beyond hold for Voxpopme?
Yeah, very excited about the 2021 and beyond. I think we continue to see growth in the overall experience management category. We see that with public companies like Medallia, Qualtrics, and SurveyMonkey continuing to really be valued at huge revenue multiples and extremely large growth at the size they're at. So I think we're going to continue to see Voxpopme adding large Fortune 500 logos. We just signed a deal with Amazon. We're launching something with Walmart in the next few months, so can't get much bigger than those two. Strategic partnerships are beginning to mature. Our relationship with Qualtrics and other leading XM solutions, we're really powering video across all of those other experience management platforms now. And Voxpopme is the leading solution in the space. We anticipate ending the year close to 10 million in ARR. Looking forward to the next stage of growth and where we go from there.
Okay, so let me try and summarize some of those points. I think the uncertainty of 2020 is possibly lifting somewhat, which of course is good. Maybe 2020 has made all of our businesses a little bit more efficient. We've certainly really focused down on culture and existing relationships, and maybe come out of this with interactions with partners and perhaps even sales cycles being shortened somewhat. So I'd like to just thank both James and Dave for your time today. Really appreciate the insights and really excited about the future. So thanks very much for that for both of you. Now I can pass on to Jill to talk about ESG at Mercia.
Thanks, Julian. Yeah, I'm Jill Williams. I'm an investment director in Mercia's private equity team. Alongside that role, I've taken on responsibility for leading our responsible investment team, which is really working towards establishing Mercia's strategy and practice around responsible investment. I'll start by setting the scene a bit. Every year, Larry Fink of MERC sends an open letter that focuses on long-term trends and issues that he considers to be pivotal to the creation of value. And this year, his letter focuses in particular on the risks and opportunities resulting from climate change, as well as on sustainability and its ability to drive better returns. He notes that companies with better environmental, social governance, or ESG profiles are currently performing better than their peers and frequently enjoy a sustainability premium. In his view, the more a company can show its purpose in delivering its value to its customers, its employees, and its communities, the better able it will be to compete and to deliver long-term durable profits to shareholders. And that focus on sustainability can really help investors to build resilient portfolios and achieve better long-term risk-adjusted returns. There are other market analysts, such as Morningstar, who are also increasingly finding a correlation in their analysis between funds that are less exposed to less ESG risk outperforming their indices more often than funds which have a greater exposure to ESG risk. And it's against this backdrop that Mercia is increasingly focused on our own role as a responsible investor. But what is responsible investment? Well, simply put, it's the integration of ESG factors into investment analysis and decision making. And why is ESG important? Well, there are several reasons, and we've heard quite a few of them from others earlier on. But as I noted earlier, building businesses in a way that is sustainable will ultimately build better, more successful and more sustainable businesses. Good ESG performance is associated with better business performance. But it's also the right thing to do. Responsible investment is already part of Mercia's DNA, and our history is really of making a difference to the UK's regions and delivering a positive social impact in our communities. And we've always seen that as an integral part of our financial return motivation. And we have, for example, supported our portfolio companies with job creation and protection within the UK's regions, as well as engaging with our communities to address inequalities and pursuing at the same time sustainable economic growth through technological innovation. So we're seeking to incorporate ESG factors while we're building and managing our portfolio. And this is a long-term focus, and it will be an evolving journey. But within the last year, we've really challenged ourselves to codify our approach around ESG. And we've looked at our own values and culture. We've looked at our origination and pre-investment analysis. And we've looked at our portfolio value creation. We've established 3 guiding principles in line with the UN's Sustainable Development Goals, which are sustainable economic growth, reducing inequalities within our communities, and health and well-being. And all of this informs our investment process. We've been guided in that approach by the UN's Principles for Responsible Investment in both the investment process and active ownership. And we've really focused our approach through our own investment team, through our people. And that's really focused on effective training and having an appropriate culture within Mercia around ESG and responsible investment. And that is really how we're going to continue to drive an ongoing dialogue and engagement with the portfolio companies. And as the industry continues to standardise, we will also continue to consider how we best monitor and report on our progress. But we're also seeking to identify companies and management teams that we believe are capable of making a positive contribution to the communities and the regions in which they operate. So along with the enhancement of returns on the one hand and management of risk on the other hand, we see an opportunity to consider how our portfolio companies can really deliver an impact. And we have a number of purpose-led businesses within the portfolio that are delivering a positive impact by disrupting their sectors. And that's across food, financial services, health, energy, all those different kind of areas. And we'll now hear from two CEOs who are leading portfolio companies that have a purpose, first of which will be Oddbox and second of which will be Nova Pangaea. Thanks for your attention.
So I'm Emilie, I'm the co-founder of Oddbox. Oddbox is a sustainable fruit and veg box tackling food waste. We work closely with farmers and rescue fresh, seasonal, surplus and odd fruit and veg at risk of going to waste. And with every box, Londoners reduce food waste, save carbon emission and water. So obviously, in terms of the biggest challenge faced in 2020, the pandemic brought its share of challenges. It meant a huge increase in the demand mid-March, where we actually saw demand within a week grow 50%. So that meant we had to close down our website. We closed it for 3 weeks whilst we were working with our co-packing and delivery partners to scale both their capacity in terms of delivery as well as packing, while they were recruiting new staff. Internally, it was also about how do we make sure that we stay close with our team whilst everyone was working remotely. And because we grew so rapidly, we also had to continue recruiting. So we adapted our recruitment and onboarding process to make sure that people felt still part of the team whilst not meeting with everyone face to face. So in terms of demand, we saw a huge increase in demand in March, and it actually continued throughout the year. So in 2020, we grew 6x. We grew a lot in London where we had started, but we also expanded to the southeast. And we now do close to 30% of our turnover in the southeast. In terms of brand awareness in the southeast, we had 3% brand awareness in July, which grew to 15% in November. And overall in London, we've now reached 25% brand awareness. So in terms of 2021 and beyond, we're very excited about the fact that we've now expanded to the southeast. We are working on expanding to the Midlands starting from May, and then Wales and up north. We hope to cover most of England by the end of 2021. In the future, we'll be looking at how we can replicate Oddbox beyond the UK and looking at mainland Europe. We did a small brand refresh earlier this month, and actually the main focus was on us being a stronger voice in the sustainability space and raising awareness about the fact that food waste is actually the most addressable solution towards climate change, as well as how we can help our customers make the most of their Oddbox and minimize their food waste at home. The whole e-commerce space has changed massively. We're not going to go back to the way we used to shop. People will continue to shop online and get things delivered. So we're obviously very positive about the future and the fact that actually our growth will continue.
Hi, my name is Sarah Ellaby and I'm the Chief Executive of Nova Pangaea Technologies. Nova Pangaea Technologies has developed a continuous process that takes seconds and minutes to convert woody and agricultural plant residues into renewable and sustainable products such as biopolymers, biochemicals, and drop-in for advanced biofuels. We enable decarbonisation and eliminate the need for fossil-based products. Biggest challenge was continuing to keep the team safe during COVID and progress our technology and commercial model validation. As a team, we've developed rigorous risk assessments and COVID on-site procedures in order to keep our team safe while continuing the commissioning and the delivery of customer trials. I'm pleased to say that we've had no positive COVID cases to date. Lessons learned. Scale up is difficult. It's very different to a mature business or a turnaround situation where you have to make hard decisions quickly. In a scale up, and as a new chief exec, you can't go in there like a bull in a china shop, but you never want to lose your instinct for what's right and wrong, and never question your gut feel. So I always like to stay true to what I believe and listen to your instincts. COVID has made us take a step back personally and professionally. It has forced us to look at business and do business differently and examine our business models with a forensic lens. It's put an emphasis on circularity and sustainability. It's not just doing business differently, it's given us a focus on how we can do things better for us as a company, our employees and the world. COVID has shown us that if we come together, we can defeat a pandemic. And if we do that, we can defeat climate change and abolish fossil-based products, which will allow us to pivot to that low-carbon world. So I have a big vision for Nova Pangaea over the next 12 to 18 months. You will see Nova start to build their first-of-a-kind RefNova plant right here in the UK. We will start to break into our top-tier markets, North and South America and Asia, through global alliances, and look to rapidly expand the team ready for multiple plant opportunities globally. We'll continue to push the technology and product innovation boundaries to outperform fossil-based products. And lastly, but not least, an eye on an IPO for next year. Watch this space.
And we're now ready for questions. The first question is, what's the current NAV of the direct investment portfolio?
I think if I was to answer that question, I would probably be taken into a dark room by our nominated advisor and had a stern word with, because we are currently assessing our year-end fair values of the direct portfolio. What I can say is that at the half year, the net assets of the business were 34.1 pence, and clearly with the announcement that we made on the 1st of March, our trading update, where we said that post-tax profits would be 23 million if we declared 8 in the first half, that means that the second half, including the realised gains, will be 15 million, and therefore NAV per share will at least go up by from 34 to nudging up towards 38 pence per share.
Thank you very much. And when you decide to invest, do you look for any good company, or do you try to stick with the ones that you're comfortable with and fit with your existing portfolio and knowledge base?
Julian, perhaps you can pick that one up.
Yeah, sure. I mean, I think, first of all, we have, as Mark said, 400 companies across our third-party funds, and they are very varied, but by both sector and stage. So there is a certainly from the balance sheet's perspective, that there's a portfolio consideration that we have to look for. But we fundamentally back good managers. The markets that they play in have to be of the right size and growing, but also we're not afraid to take a nascent management team and use our resources, as Mark has said, to add to the capabilities and skills around that team. So there's a lot of different factors that go into an investment decision, but one of the key ones is really around, as I said, the the management themselves and their ability and whether or not we can ultimately work with them.
Thank you. And how rapidly can you grow third-party funds under management organically, and do you need to make acquisitions to grow?
So I'll pick that up. I mean, we made a commitment a couple of years ago now, a sort of 3-year strategic plan where we would grow assets under management from 500 million to 1 billion, and we're nudging past 870 million. We think we can get to that billion mark organically, so we don't think we have to make acquisitions. That said, we are in an acquisitive arena, and opportunities I'm sure will arise. And if they do arise, as we spoke about earlier, we have good levels of cash actually within the business to take advantage of opportunities as and when they present.
As a result of the pandemic, has sector become more important than management team when assessing prospective investments?
I think, again, as Mark said, there's certain sectors that we would struggle with now as a result of the pandemic, and there's certain things that have fundamentally changed, I think, in the environment. But that said, management is still absolutely crucial. We are very keen now on certain kind of diagnostic platforms and telehealth, security, and businesses that really are looking at their own efficiency, and that really does to some degree translate to some of the software businesses that we are seeing. But also, as I've already said, the current situation and the focus on ESG and lower carbon environments does also present some significant opportunities for us, and there are a lot of innovations and innovators in that sector that we're very well aware of.
And I can add to that in terms of the key thing here is one of balance, portfolio balance, in terms of stage of business and in terms of type of business and sectors and markets they operate in. So something I'm sure people will have picked up is from the 4 presentations that you've heard from the 4 founders that you've heard from management teams, is it's a diverse portfolio within Mercia, and they're all exceptional businesses. So sector diversity is really critical, and an ability to spot emerging sectors is really important. And part of our model, our ability to support these businesses through our funds initially, gives us our opportunity to learn actually through those. But fundamentally, it will always be about backing good teams. The individuals running these businesses really, they put their heart and soul and 24/7 into this. And at some point along that journey, they have to pivot and change and adapt. And those are the people that you're backing. The businesses, it's very interesting. We often reflect internally the businesses we backed and the business we exited. Those businesses that exited have typically pivoted and amended and changed during their journey. And that's down to the exceptional teams that we back. So we will always back exceptional teams first.
Thank you. As your more mature investments grow and attract interest from other private equity groups and VCs, how will you work with them to introduce them onto the register without diluting your stake materially? Presumably, pricing of the funding round is the biggest influencing factor.
Yes, of course. But I think also there is a real kind of important factor around who our co-investors are, and we do work with a number of really good co-investors and actually corporates as well. So this is not just about pricing, it is also about what any co-investor does actually add to the party, and whether, of course, we can work with them and share the same visions for that asset. So it's a combination of factors, actually.
And Julian, if I can just add to that as well. There's a changing world in terms of capital, in terms of living alongside and passing batons on. So Jill from our private equity will be very familiar with, you build a business as a private equity house, and then you sell it typically onto another private equity house as they take it forwards. Now within venture, that's starting to happen too. So you're seeing secondaries happen within venture. So you've got co-investors, but you've also got partial and complete exits as well. So it's a very dynamic industry. that we're operating in. And this is one where trust and relationships are really important. And you very often will co-invest with the same investors, and you'll be selling to the same private equity-backed businesses. And we've sold businesses to the same private equity houses, a number of businesses, very successfully because of that.
And perhaps I could just add one final point, which of course is with our significant dry powder, if we choose to, we can always hold our corner.
Thank you. And what involvement do you typically have in your businesses under management in terms of board representation and offering tangible support when things go wrong?
So certainly, again, for the most part of our assets, we are on the board, or if not, certainly an observer. But all of our balance sheet assets, we are on the board of those assets. And I think the important thing for us is to recognise that in order for us to add value, we typically are able to signpost those management teams to other great management when we need to perhaps add a CFO or a COO or indeed an individual that helps that business get into another market. So for us, it's really having the experience to know when there's a gap that needs to be filled. And as Mark said, we have a portfolio resourcing function within Mercia that does just that. We've got over 650 now non-executive directors and executive directors within our own networks that we can choose and really kind of add into those businesses for help. We can also add what we call kind of operational venture partners, which may be for a particular exercise when we need to help the teams look at a sales process or a regulatory issue or something like that. So I think really the value that we bring is in the networks and the ability to spot and add other individuals into those teams.
And that's an excellent point that Julian makes there in terms of expertise, but it's also worth just stepping back from what it is that Mercia does. So when I discussed the assets we manage, we obviously have debt, private equity and venture. And in terms of debt, we don't take a board seat when we're putting debt to work. We're investing in profitable cash generative businesses and frankly collecting back that debt from it. With private equity, in which Jill sits within that team there, it's about operational efficiencies and improvements. So we're driving an operational dynamic into a business as we seek to get these businesses growing and more profitable. Whereas, of course, within venture and within private equity, we do take a board seat because we're trying to drive that from the board perspective. And within venture, typically these are pre-profitable businesses. So here you are driving technology development, you're driving business model development, you're working with management teams to help them scale. And we've heard today about the challenge of scale, and we shouldn't underestimate that. Scaling up a business is not an easy task. So we're there to support teams to try and scale those businesses as well. So there are different aspects and requirements at a board level, depending on the asset class, if you like, that we're putting to work.
Thank you. And do you have performance data or a track record that you can share for any of the funds?
So I'll take this initially, and I'm sure Julian can pick up on this, is that it depends on the funds under management. So for instance, with our VCTs, the Northern VCTs, it's in the public domain. You can see the performance of those VCTs and it's publicly available. So you can see that. Within our EIS funds, they are reported against by providers such as Allenbridge and Churchill. And again, you can see the performance through those reports on our EIS funds. And both of those, both the Northern VCTs and the EIS funds, are performing extremely well. With our other funds, which are limited partner structures, such as venture and such as our private equity, that's much more sort of kept quiet, quite maybe not the right word, but it's within the LPs who have invested in those funds. It's not in the public domain, typically. In that respect. So I'm afraid that isn't available publicly. And then if you look at our balance sheet and our direct investment, again, you can see from our annual reports on how that's working. And that, from a balance sheet perspective, it's typically a sort of 15-20% portfolio IRR. So again, I think performing very, very well in that respect.
Thank you. Could you give us an update on your largest directly held investment, nDreams?
Yeah, sure. I can certainly do that. So I'm on the board of nDreams, and so the business is trading very, very well. It's just gone past its year end. Its turnover, again, not not finalised yet, but it's going to be significantly up on previous years. A lot of activity going on. It's got its primary game, which is called Phantom, has sold very well. It also got another game called Shooty Fruity, which is available on the Quest, which again is selling well. And just recently, in just this month, it announced its latest game, which is due out on Sony's PlayStation. It's called Fract, and again, there's some really interesting publicity just around that game, which again should be launched over the course of the next month or two. So yeah, it's good progress, and indeed the market is looking interesting as well, and hopefully when we all kind of come out of lockdown, there'll be the arcades and the LBE centres, which also have increasing VR content and capabilities that you'll also see coming to the fore as well. And nDreams is well into that sector as well. So good progress.
And I think we've got time for one more question. What tough decisions did you take when COVID hit?
Yeah, so back in this time of last year, as Mark has alluded to, we did a really in-depth study across all of our portfolios to really try and, I guess, look into the crystal ball to see which sectors and which assets would really be survivors long term, not even medium term, but long term. And so we took a pretty hard decision. We had a business that was really kind of looking at the events industry. That's both a fund and a balance sheet asset, and we really couldn't see a short-term or indeed medium-term future for that business. So we ended up selling our stake back to the management. So we have taken those types of tough decisions, but hopefully, thankfully, not too many of them actually.
Yeah, and on a corporate basis, of course, when this started in March, this was horrendous, frankly, and you sort of looked at an uncertain, unprecedented time. And I spoke at the very beginning that Mercia is all about its people, and it absolutely is all about its people. And so what we had to do is work very carefully with the team as we moved to remote working, but also quite toughly in terms of remuneration, in terms of corrections, in terms of those sort of things. It's unfair when you are working and being quite tough and hard on investees to behave, and it's back to being a responsible investor, to behave by paying yourselves more, so there was no pay increases across the group. The executives actually took a significant cut in terms of, and a permanent cut in terms of their bonus payments, etc. We felt that was the responsible behaviour to do when our investees were actually going through equally challenging times. What was great, really fortunate for us and our portfolio companies, is that they've come out more the stronger actually through this period. And it has felt like we're in it together. We talk internally about a one Mercia, but that one Mercia is much more broader than just the team. It's about the portfolio as well. And we work very carefully and closely with each other. It's been a remarkable environment, actually. We've done things just like having magicians and providing for magicians for our portfolio, so that people can have their children being entertained and get an hour so they can get on the phone and do some work and sales. So we've done, we think we've behaved responsibly and worked closely with our portfolio. But on a corporate basis, we've really had to be careful And it's always, you always hear about cash is king, but we've had to be very, very careful with our cash.
And I think just from a financing perspective, we have an expression within Mercia, which is that if you overreact too soon, you've probably got it about right. And so the toughest decision for us was not to overreact too soon. And then when one stands back and realizes that over 90% of our revenues were contracted, and over 83% of those revenues we self-collect, that gave us the confidence to not overreact, to not let people go, and to stick to our culture and our principles, and that's seen us through.
Thank you. And I'm afraid that's all we've got time for. Mark, do you have any closing remarks?
Yeah, no, I mean, a number of you will have seen, we put an RNS out about our prelims that will be coming out on the 6th of July. And we will be actively engaged in forums like this to make sure that we're talking about our results and giving an opportunity for you to ask us those questions like you have done today, which we've really enjoyed. And we look forward to that. And I think just in closing, what I'd like to do is frankly, personally thank the investees. You've heard a number of them today, but they have worked really tirelessly and hard. And thank them for their support and frankly their belief in Mercia and coming to Mercia. I always think that they choose us, not we choose them. I'd like to thank our fund investors as well, shareholders in our VCTs, and importantly, our shareholders in Mercia, and the belief in what we're trying to do in terms of delivering this model, but also a belief in the domestic economy, which is the UK economy, because that's where we focus. We focus in the regions, and we have this backdrop now of an economic recovery, and we think we're really well placed to return that support for you. And I'm hoping that you will see from our H1 results and what you anticipate for our H2 and full year results that this model is delivering and will continue to deliver going forwards. So thank you very much for your time, attention, support and belief, and we look forward to engaging with you very, very soon.